Hello everyone, welcome to the official YouTube channel of Office Assessor 24/7. My name is Amanjyot and today we are going to discuss a very important topic of your principles and practices of banking, that is factoring and forfeiting. Okay, so today we are going to discuss about what is factoring, what is forfeiting, and we are going to understand the concept behind these two topics. Okay, now this is a part of your module A subject. This is a part of your module A, factoring and forfeiting. If we talk about factoring and forfeiting, what actually it is a part of alternate source of finance. As we all know, whenever we talk about the sources of finance, the 60% source of finance comes from the commercial banking system of our country. As we know, many people are linked to the commercial banks, and this is the easiest form to get the finance or get the finance sources from the commercial bank. So that is why we are saying that 60% sources of finance comes through the commercial banks of our country. But when it comes to the requirement of the funds of the country, it is not possible that only commercial banks will fulfill the need of the money. Because when we talk about financial system, what is financial system? It simply means the system where exchange of funds will be done among the persons who have surplus of money and the persons who have deficit of money. So whenever it comes to the requirement of the funds, we have a commercial banking system. It means we have a banking system. We have a non-banking financial system also. Apart from that, we required a certain sources which helps us to raise funds or to get funds whenever we need the funds. So all that form of the types, or we can say all the types from which you are getting money apart from commercial banking system, that is known as your alternate source of finance. Okay, so factoring and forfeiting both are the part of your alternate source of finance, and that's what we are going to discuss today. Okay, now before moving to the topics, first of all, those candidates, those persons who are new to the Office Assessor 24/7 channel, do subscribe the channel and press the bell icon so that all the upcoming sessions notification will be given to you. Okay, so this is the channel which you have to subscribe to get all the upcoming sessions notification. And apart from that, if you have not downloaded the Adda 24/7 application, then do download the application, because with the help of this application you will be knowing that which are the running batches on Adda 24/7 application and which are the coming batches which is going to help you to prepare for your JAIIB, CAIIB exam and any other bank promotion exam. Okay, now let's move forward towards today's topic, that is module A's topic, that is factoring and forfeiting. We are going to discuss today. So what is factoring, what is forfeiting, we are going to discuss. So let's start with the factoring first. When we are talking about the factoring, what is factoring? It is a alternate source of finance. What I am saying, it is a alternate source of finance. Okay, so whenever we talk about factoring or forfeiting, these are the part of the alternate source of finance. What is the meaning of alternate source of finance? It simply means that what we are talking about here, that we are having another sources also apart from commercial banking system of our country to get funds whenever we need. Okay, so these are also a part of financial system in which we are getting money. Now what are the different types of alternate source of finance is there? We have crowdfunding. Okay, crowdfunding is there. Apart from crowdfunding, we have peer-to-peer lending, which is also important part of your subject. Apart from that, we have factoring, forfeiting, we have angel investors, we have joint venture capitalists. So these all are the methods. We have hire, purchase, lease. These all are the methods by which alternate source of finance used to raise money or to get money whenever you need the money. Okay, so let's start with the factoring first. It is a part of alternate source of finance. Before coming towards the definition of factoring, let's understand what actually the factoring is. If we talk about factoring, so factoring is simply an alternate source of finance. It is used by the buyers or sellers. It is used by the parties who comes under an agreement to sell or purchase certain goods and services, and they want a immediate cash. The requirement of immediate cash makes the people to use the factoring or as well as the forfeiting. Okay, so whenever there are two persons who are buyer or seller, we can say they came into an agreement that they want to sell the goods and purchase the goods, but the buyer is saying that I am going to pay you the money after a certain period of time, and the buyer has given a due date to pay the amount of goods and services to the seller. In that situation, we need factoring and forfeiting, because always the seller has a requirement of immediate cash which is not going to be paid by the buyer. That's why we use the factoring or forfeiting. Okay, now how it works, let's understand first that if we talk about talk about factoring, first let's say we have seller. Okay, one party is seller, that is also known as your client, and the other party is your buyer. There are two parties, buyer and seller. We can say your client is there. Okay, let me write it little bit big. So first we have seller and second we have buyer. Okay, so there are two parties in the contract. Buyer is saying that I want to purchase a certain goods and services, and seller is agreed to sell the goods and services to the buyer. Now these two parties came into a contract. Now seller has done, in first situation, seller has sent the goods to the buyer. What seller has done? Sent the goods to the buyer. We are trying to understand the mechanism of factoring, then we will come up to the definition of the factoring. Okay, so first of all, let's understand step by step how factoring or forfeiting work. Those both are working together, both are working similarly, but the only difference is when it comes to the factoring, we use buyer and seller. When it comes to the forfeiting, we use exporters and importers. Okay, now let's see there. So there is a two party, one is seller and another one is buyer. So seller has sent the goods to the buyer. Now what buyer is doing? Buyer in the second step sending, let's say, promissory note or a bill of exchange. Buyer has given a promissory note, or it can be a bill of exchange, or it can be any invoice which buyer is giving to the seller, okay, for the repayment of the goods and services. Now buyer has said that this will be done on a due date. Okay, the due date has been given. Let's say, for example, on 1st of August, seller has sent the goods to the buyer, and buyer has given the due date for the payment, that is 30th of August. That is 30th of August, let's say. Okay, so this is the agreement between buyer and seller, that buyer has got the goods on 1st of August but going to pay for those goods and services on 30th of August. So what buyer has done? Buyer has issued the promissory note or bill of exchange. Acha, let me know. Good evening, Raja. Acha, let me know what is promissory note and what is bill of exchange. Do I have to also clear the concept of promissory note or bill of exchange, or do you know about all these terms? Let me know. What is promissory note and what is bill of exchange? You have to tell me, so that we will go forward to the topic. Or if you do not know about these two terms, let's first discuss these two terms, then we will move to the factoring topic. Now let me know. Do you know what is promissory note, or do you know what is bill of exchange? So first of all, we have seen that buyer has got the goods and given a promissory note or bill of exchange on a due date, that is 30th of August, let's say, for example. Now there will be a third party, that is known as factor. Third party will be known as factor, and this third party can be bank or can be your financial institution. Okay, this third party can be your bank or the financial institution. Okay, so now Bharti is saying they do not know. Okay, so first of all, let's understand what is promissory note and bill of exchange. Both are negotiable instrument. If we talk about promissory note or we talk about bill of exchange, both are promissory note and bill of exchange are negotiable instrument. These are simple a piece of paper in which it is a writing piece of paper in which one party is promising to another party to pay a certain sum of amount on a certain date to the particular certain person by signing a document. Okay, that is promissory note. Similarly, same is the bill of exchange. But what is difference between promissory note and bill of exchange? The first difference is that in promissory note there will be two parties only, but when we talk about the bill of exchange, we have more than two parties in the bill of exchange. Okay, so both are negotiable instrument, both are instrument in writing. When it comes to the promissory note, it is an instrument in writing in which undertaking will be taken by the maker of the particular instrument, maker of the promissory note, that I am promising you I will pay you a certain sum of money on a certain date to a certain person, and the person who is making it will have to sign that particular document. Now when it comes to the bill of exchange, it is same, but only difference will be more than two parties can be involved in the bill of exchange. And the another part is unconditional order will be given under the bill of exchange, but when it comes to the promissory note, unconditional undertaking will be taken by the maker of the instrument. It means what? It means in promissory note, let's say I am the maker of the promissory note. Now I am taking an unconditional undertaking that whatever happens, I am going to pay your money to you on 30th of August. That is the promissory note's condition. That I am taking undertaking, I am going to pay you the sum of amount on a certain date, and I am signing the document. That is promissory note. But when it comes to the bill of exchange is also a document in writing that contains an unconditional order. In bill of exchange, the maker of the document is giving order to the bank or financial institution that you have to pay this amount of money to these certain parties on a certain date, and the maker of the particular document will sign that document. This is the difference only between bill of exchange and promissory note. Okay, I hope it is clear now. So promissory note is unconditional undertaking, and it contains two parties only, and bill of exchange is an unconditional order and it contains more than two parties also. Okay, this is the difference. Now what we have done, buyer has given a certain promissory note or bill of exchange to a seller that I am going to pay the amount of goods and services to you on 30th of August. That is the promissory note or bill of exchange has been given. Now we have a factor. Now who is factor? Factor can be factor is your third party. It can be bank, it can be financial institution. Okay, now seller is going to have a money on 30th of August, but seller needs immediate cash to start the production of another consignment which he has got. Okay, so what the seller has to do, seller will go to the factor. Okay, seller will go to the factor and ask for the immediate cash requirement, that this is the bill of exchange or this is the promissory note. I am going to get money from my particular buyer on 30th of August, but I need a immediate cash. So bank, it means the factor is agree that yes, I will be agree that I am paying you this amount today on 1st of August, and I will taking money from the buyer on 30th of August. Okay, so this is what we have done here, that the seller went to the factor, that can be bank or financial institution. Okay, so in third step, what seller will do, seller will assign the invoice, or in case of invoice we can write also promissory note or bill of exchange. Let's write promissory note or bill of exchange here. So the seller will assign the promissory note or bill of exchange to the factor and ask for the immediate cash from the bank or the factor, we can say. Now what factor is saying, that yes, I am agreed to pay you the amount of that particular promissory note or bill of exchange on a certain date, that is 1st of August, but what I need a certain fee. So commission will be charged by the bank, by the financial institution. It is obvious they are not going to give you the facility or service free of cost. So whenever you are going for a factoring, whenever you are going for an immediate cash requirement, you are giving your invoice to the bank, and then bank is giving you the money, immediate cash. In that situation, what bank will charge? Bank will charge a certain commission, bank will charge a certain fee to the customers from the seller, from the client. Okay, now in that stage, in that condition, what fourth step will be? In fourth step, bank will pay the advance, bank will give the advance payment to the seller. Okay, and the client will get advance payment in the fourth step of factoring mechanism. Okay, now in case of factoring, if we talk about factoring, up to 80% of invoice amount will be given as an advance payment to the seller. Do remember, certain questions can be asked here, that what amount of invoice percentage can be given by the factor to the seller in case of factoring. So up to 80% can be given. So 70 to 80% bank give the immediate cash to the seller. Okay, now this is the fourth step. Now in fifth step, whenever the due date will arise, okay, whenever the due date will arise, the factor will go to the buyer on due date. On due date, the factor will go to the buyer and ask for the payment of the promissory note or bill of exchange, or we can say certain invoice, whatever the buyer has given to the seller. Okay, it will ask about that. So on due date, what bank has done, what factor has done, factor went to the buyer. Now what buyer has to do in the sixth step? In sixth step, buyer has to, in sixth step, what buyer has to do, buyer will give the payment to the bank, or we can say factor. Buyer is giving payment to the bank or the factor on the due date. Okay, so this is the proper mechanism of factoring. I hope the mechanism of factoring is clear to all of you. Just see once in the first step what we have done, we have sent goods from seller to buyer. In second step, buyer has issued a promissory note or bill of exchange or any invoice by which the buyer is ready to pay to the seller on a due date or on a future date. Okay, now because seller need an immediate cash, so seller went to the factor or the financial institution or the bank and ask for the advance payment after assigning the promissory note or bill of exchange to the factor. Now do remember one thing, when we talk about promissory note, you cannot write the PN. Writing PN for promissory note is not right. Writing P notes for promissory note is not right. You have to return full spelling of that promissory note, because when you are writing P note, it denotes the participatory notes. When you return the P notes, it also represents the participatory notes. So these two abbreviations are not correct for your promissory note. Okay, now in that situation, in third situation, seller has given the factor, the financial institution, the assigned the promissory note or bill of exchange, and in fourth step, what happened, the bank has given the advance payment up to 80% to the seller. Now in fifth step, whenever the due date came on 30th of August, bank went to buyer and asked for the payment, and buyer has done the payment to the bank. Okay, now the remaining money will be given to the seller by the bank after the bank accepted the money on 30th of August. So this is the proper mechanism of your factoring. Okay, now let me know, is it clear to everyone? Mechanism is clear to everyone? Now let's understand what factoring is. Now let's come to the definition of factoring. Okay, so you can see here what is factoring. Factoring, receivables factoring or debtor financing. You can call it receivable factoring or debtor financing. It is when a company buys a debt or invoice from another company. Okay, what you are doing, you are buying debt or finance from another company, that is known as your receivable factoring or debtor financing. Okay, now next is saying it is a financial transaction and a type of debtor finance. Okay, you can say it is a financial transaction or it is a type of debtor finance in which a business sells its account receivables, that is invoice. It can be in the form of promissory note, bill of exchange, or simple an invoice to the third party, and third party will always be your factor at a discount. Okay, so a business will sometimes factor its receivable assets to meet the present and immediate requirement of cash. Okay, so when you require the immediate cash, when you required the when you are in the need of the cash, in that situation you can use this particular factoring to get the immediate cash, to get the immediate money. Okay, now next thing is saying factoring is a very common method used by exporters to help accelerate their cash flow, and forfeiting will be same, in factoring will be same. Okay, in the international trade maximum forfeiting is used, but factoring can also be used. Okay, now next thing is the process enables the exporters to draw up to 80% of the sales invoice value at the point of delivery of the goods and when the sales invoice is raised. Okay, so the up to 80% amount will be financed, will be given by the factor to the seller or the client at the time of factoring. Okay, now next thing is how many parties will be there. There are three parties. First is factor, and factor will be your bank or your financial institution. Okay, when it comes to the customer or debtor simply means your buyer, and seller or client means simply your seller. Okay, now in case of factoring, whenever we talk about the let's say for example, whenever we talk about the seller or buyer or bank or factor, so whenever we went to the bank, so whenever I am going to the bank and I am asking certain finance from the bank, now what bank has to do? Bank has to check my credit history. Bank going to check my credit history. After checking my credit history, what bank will do? Bank will go to the CIBIL and get a credit score of mine, and then will allow give to loan or finance to me. Okay, it means whenever bank is giving you loan or bank is giving you finance, banks always check your credit history. So in case of factoring, that will be done both for the seller and the buyer, and bank will be more concerned about the credit worthiness of buyer in comparison to seller. Why? Because at last we have seen in the mechanism, at last bank will get the payment, the factor will get the payment from the buyer of that particular agreement. So that's why whenever it comes to the credit worthiness, what we are saying, the factor is more concerned with the credit worthiness of the invoice party than the company from which it has purchased the receivable. So bank purchased the receivable from whom? The seller, the client. So bank will be more concerned about the credit worthiness of the buyer in comparison to seller. Okay, because at last buyer has to give the payment to the bank. Now this is your factoring. So a factor is essentially a funding source that agrees to pay a company the value of an invoice less a discount for commission and fees. Okay, so bank is always going to take a commission and fees from you whenever bank is financing your particular document or invoice, right? Now, next is the terms and conditions set by the factor may vary depending on its internal practices. Okay, whatever terms and condition bank is giving here at the time of factoring, it can vary. Okay, it depends on the internal practices only. Now, next thing is there are two types of factoring. First is recourse factoring and second is your non-recourse factoring. These two types of factoring is there. Good evening, Jadipa. Now, next thing is types of factoring. We have two types of factoring. First is recourse and second is non-recourse factoring. Now, what is these recourse and non-recourse factoring if we talk about? So, whenever we are talking about types of factoring, in case of recourse factoring, if the buyer defaults, let's take in a condition that bank went to the buyer on 30th of August and buyer has said that I'm not going to pay you the money or I do not have the money, or in any certain condition when the buyer's defaults in case of recourse factoring. Now what the factor will do, factor will take money back from the seller which he has given under the factoring. Okay, in that situation what will happen? The seller have to return money to factor. In which case we are talking about here, in case when the buyer defaults in the factoring, which type of factoring? In the recourse factoring. So in recourse factoring, if buyer defaults in that situation, the seller has to repay the money or return the money to the factor. That is your recourse factoring. Okay, now what is your non-recourse factoring? If we talk about non-recourse factoring, what is non-recourse factoring? Just opposite. In case of buyer defaults, okay, in case of buyer defaults, what happened? The seller do not required to return money. So what we are saying, in case of non-recourse factoring, the seller do not have to return the money to the factor. Now who is factor? Your bank or financial institution. Okay, why this is these two types of factoring is there? First we talk about, whenever we talk about the recourse factoring is the type of factoring in which whenever the buyer defaults, the seller, or we can say the client of the bank, has to repay the money to the factor. Why? Because it do not give the protection towards your bad debts. Okay, when the buyer defaults, the bad debts will be created and bank do not provide the protection against that in the recourse factoring. But in non-recourse factoring, bank will provide protection, and that's why they do not have to return the money. The seller do not have to return the money. Now in that situation, when in one type of factoring you are getting the protection from bad debts, and another you are not getting the protection, it means the commission will be charged high in case of non-recourse factoring. Here high commission will be there. High commission will be there because you have a protection against bad debts. Okay, that's why you are getting a that's why the seller do not have to repay the money to the factor or to the bank or the financial institution. Okay, so this is the two types of factoring. Now let's understand the definition of both. First of all, you can see here, in case of non-payment of invoice by the customer means your buyer, the factor will recover the amount advanced from the client. Now client means your seller, and when we are talking about your customer, it means buyer. So whenever buyer defaults, the amount will be recovered by the factor from the seller. But in case of non-recourse, what we are saying, the factor provides both finances and credit protection. In case of non-recourse factoring, both will be there. First is your finances, it means you are financing the amount, you are giving immediate cash, and second, also you are giving the credit protection. So in case of non-payment of invoices by customer means buyer, the factor will bear the risk of bad debts. Factor means the bank has to bear the risk because they have taken high commission from the customer, from the not the customer, from the client, that is seller. So bank will bear the all risk in case of default from the side of buyer. Okay, so this is what we have discussed in the factoring. I hope factoring is clear to everyone. Now let me know factoring is clear or not. If you still have any doubt on factoring, then ask. Good evening, Shashanka. Now let's come to the forfeiting. Forfeiting is similar to the factoring. The only difference is that in forfeiting only exporter and importer will participate. The domestic trade will not happen here. Okay, so what is forfeiting? Same will be there. If we talk about the mechanism, let's come to the mechanism which we have discussed. If we talk about the mechanism, what changes will be there in comparison to seller? We will have exporter. We will have exporter. When we talk about forfeiting, if we talk about forfeiting in a place of seller, we will use the word exporter, and in place of buyer, we will use the word importer. Okay, and in place of factor, what we are using? We are using forfeiter. We are using forfeiter. So this is the only difference between factoring and forfeiting. So in forfeiting, what we are talking about, we are saying simply we have exporter, importer, and the next party will be your forfeiter, that will be bank or financial institution. That is the only difference between factoring and forfeiting. Now let's come to the definition of forfeiting. It is saying it is the purchase of an exporter's receivable. Now exporter's receivable means whatever invoice or promissory note or bill of exchange or letter of credit, whatever the exporter got for the payment of your shipment. Okay, so that will be received by the factor, and what we are saying, the amount that the importer owes the exporter, that the importer owes the exporter at a discount by paying cash. So when exporter requires immediate cash of the foreign trade transaction they have done between the whatever the foreign trade transaction done between the buyer and seller, it means exporter and importer, and in case of exporter requires an immediate payment, he or she can use your forfeiting. Okay, next is the purchaser of the receivables or forfeiter. Now the factor here will be known as your forfeiter. Okay, that is your purchaser also, who is purchasing invoice from you, who is purchasing receivables from you. Bank is doing so, financial institution is doing so. So that will be known as your forfeiter. Must now be paid by the importer to settle the debt. Okay, now in factor we have discussed that buyer is going to pay the money to the bank, so similar thing will happen, that importer will pay the money to the forfeiter. Okay, now what we are saying, this is a common process used for speeding up the cash flow cycle and providing risk mitigation for the exporter on 100% of debt values. Okay, of 100% of debt values. Now next is, as the receivables are usually guaranteed by the importer's bank, the forfeiter frees the exporter from the risk of non-payment by the importer. Okay, so there is no risk that the importer will not pay the money to the bank or the forfeiter. Okay, now next is, when a forfeiter purchases the exporter's receivable directly from the exporter, then it is referred to as the primary purchase. Okay, so when the forfeiter is purchasing the receivable from the exporter directly, it will be known as your simple primary purchase. Okay, now what we are saying, that the receivable technically then become a form of debts instrument that can be sold on the secondary market. Now what bank can do? Bank can sold that to the secondary market also. Let's say bank has taken the bill of exchange or promissory note from the exporter. Now bank has financed that particular exporter from the money. He has given the money to the exporter on 1st of August, let's say, which we have taken example in the mechanism. Now what we are saying that what bank will do? Bank will in the secondary market, bank can sell that particular receivable to another person and get money from that particular person and earn interest on that. Okay. Now next thing is, in the secondary market as a bill of exchange or promissory note, this is known as your secondary purchase. Okay, that is known as your secondary purchase in the forfeiting. So the mechanism is same, process is same thing we are doing here. This is the same financial transaction we are performing, but between the exporter and importer. Okay, now next. It means it is a means of financing that enables exporter to receive immediate cash by selling their medium and long-term receivables. Okay, the amount an importer owes to the exporter, that is your long-term or short-term receivables. Okay, now next is at a discount through an intermediary. Intermediary will be known as forfeiter here. Now exporter eliminates the risk by making the sale without recourse. Okay, it means we are seeing non-recourse. Without recourse is also known as your non-recourse. So there are also two types of forfeiting, that is recourse and non-recourse. When you are using non-recourse forfeiting, it means the risk will be eliminated. Okay, risk is eliminated. That's why we are saying without recourse, or we can say non-recourse also, that is giving you that is eliminating the risk of default in the forfeiting for the exporter. Now next is, it has no liability regarding the importer's possible default on the receivables. Now next thing is, the forfeiter is the individual or entity that purchases the receivables, and the importer then pays the receivables and amount to the forfeiter. So I think whatever definitions we are reading here, it only making sense if you are if you have understand that mechanism I have told you in the starting of the session. If you have understand that mechanism, now every line will be understandable to you. Okay, so these are the two terms which is very important, and 2 to 3 questions can be asked from factoring and forfeiting, and that is guarantee in every exam of your PPB. Whenever you are going to give an attempt, there will be question from the factoring and forfeiting. It's a very important chapter. If you have joined the session late, then do watch the session again, do understand that mechanism we have discussed, because that is what you have to understand as a conceptual understanding of this particular chapter. Okay, so this is what we have discussed in the factoring and forfeiting. Now let's come to the particular information for all of you, that is regarding your November JAIIB exam. So I think you all are preparing for November JAIIB exam, and we have targeted that we have to qualify this exam in this November attempt only, because from 2023 the syllabus is going to be changed and we do not risk our time. We have a sufficient period of time to qualify this particular exam if we start from today onwards. If you start giving a certain 2 to 3 hours for your preparation for the JAIIB exam, then there is a guarantee that you are going to qualify this exam in the November month. Okay, now these are the 2 batches which are available on Adda 24/7 application. One is bilingual, one is English medium. So this is an English medium batch. One second. So this is an English medium batch which is starting from 25th of July. So from 25th of July, your English medium batch is starting on Adda 24/7 application, and the PPP subject classes will be from 7 to 8 a.m. morning, and the schedule is already updated on the website. You can check the schedule also on the website to know how we are going to cover your syllabus. Okay, apart from this, there is a bilingual batch also which is starting on 18th of July. In bilingual batch, the content will be in English, but the explanation will be bilingual. Okay, now what you will get, 140 hours classes will be there. That will be live class. You can interact with your mentor at the live class, and 60 plus ebooks will be there, 80 plus topic wise tests will be there. Recorded videos will be available 24/7. If you miss someday the live class, then you can check that particular live class in the recorded form. That will be available with you 24/7. Okay, but focus on attending the live class, because in which you will be able to interact with your mentors and clear your doubts, your queries at the same time. Okay, so these are the batches. To enroll in these batches, what you have to do, you have to use a code, that is Y496. If you use this Y496 code, you will get 78% discount on each and every batch on available or 24/7 application. Okay, and if you want to buy the test series, because that is very much important, topic wise test will be available in your batches. There is topic wise test available in your batches, but when it comes to the full length test, there will be very necessary that is very important to give the full length test, because then you will be able to know that whatever preparation you are doing, that is going in the right direction or not. If you are not giving mock test, then you do not know that you are giving your time to the preparation, but you are going to qualify or not. That will be a doubt. Okay, so that's why we need a practice. We need a topic wise test practice, and we need a full line test practice also. Okay, so to get the test pack of Adda 24/7 application on 50 plus test will be available. You can use the code Y496S. Okay, for test series you have to add in the end S, and for the product you have to use simply the code Y496. Okay, so this is the information for all of you. One more information for all the persons who have qualified the JAIIB CAIIB exam, who has passed the JAIIB CAIIB exam in the 2022 attempt. So we are celebrating their success. We are celebrating their success on Adda 24/7 app, on Adda 24/7 office on 23rd of July on 12th p.m. Okay, on 12 p.m. So this is a felicitation ceremony for all the candidates who have passed their JAIIB and CAIIB exam on Adda 24/7 office, that is in Gurugram. This is the address given here, and 23rd of July is your day, and timing will be 12 p.m. So all of the candidates who have qualified JAIIB CAIIB exam in 2022 attempt, you all are welcome here. First of all, congratulations to all of you for your success, for your success, or when you qualified this particular exam, you have given a certain time to it and you have given a certain dedication to it. So congratulations all of you, and we are here to celebrate your success with you. So this is a felicitation ceremony going to held on 23rd of July. Okay, now last but not the least, if you are new to the Offices Adda 24/7 channel, do subscribe the channel and press the bell icon so that all the upcoming sessions notification will be given to you. And if you like the video, do like the session and also share the session with your colleagues who are linked with you on the different social media platforms. Okay, so thank you all for joining the session, and if you still have any query regarding forfeiting and factoring, you can ask in the comment section. I will check your queries and answer them. Okay, so thank you all for joining the session, and stay safe.